Good day to everyone. Today we are going to consider how to prepare final accounts of a sole trader with respective analysis on the additional information. We might not be able to solve all the or prepare the income statement alongside the statement of financial position, but I'm going to take you through the additional information, how to deal with additional information with respect to adjustment to the non-current assets, adjustment to expenses and income, adjustment to the closing inventory, or other elements of financial statement. So let's take a look at the question that was being given to you in class. That's Sir John Enterprise. And I've been saying that when a final accounts question is being given to you, or when you are being asked to prepare the income statement and statement of financial position of a sole proprietor, the first thing that you have to consider under examination setting is to read through the additional information first. Go through the additional information. After going through the additional information, you glance through the trial balance. But as we already have the question at hand, so let's consider that we've gone through the additional information and we are considering the trial balance. The reason why you have to go through the trial balance as well is that sometimes most of the additional information, most of the items within that additional information are linked to the items or to the accounts in the trial balance, and therefore it is paramount for you to consider that. So let's see the trial balance of Sir John. I will definitely place the question on the screen so that we can get to know the question as well. So Sir John's trial balance as at 31st December 2023 was as follows. We have the non-current assets at cost, fixtures and fittings. We have motor vehicle, we have plant and equipment, building. They are all having balances at the credit side, debit side. Then we have the accumulated depreciation of the various non-current assets I just mentioned. We have the fixtures and fittings, and the accumulated depreciation is the same as provision for depreciation, and they are all located at the credit side of the trial balance. We have purchases and sales. When you see purchases and sales, it means that when you check the debit side, the figure there represents the purchases and the credit side represents the sales, because purchases is having a debit balance and sales is also having a credit balance. We move on to the return inwards and return outwards. You can infer from the question that they are all on the same line. Return inwards is having a debit balance and return outwards is having a credit balance. We have discounts allowed and received. Discounts allowed is an expense and therefore it is having a debit balance. Discount received is an income and it's having a credit balance. So as at this level, you must be able to determine the elements of financial statement and their balances as well. If you want to prepare accounts for a sole trader, that is the income statement and statement of financial position. For you to understand it well, you must know the elements of financial statement and their balances. We have wages and salaries being an expense, advertising expense, insurance is also an expense, bad debt written off an expense. We have provision for doubtful debt is a provision and therefore it is having a credit balance. We have inventory at the beginning of the year, that is opening inventory. We have capital, that is equity. We have drawings. We have cash at bank representing bank. We have 6-month treasury bill, that is a current asset investment item. And we have cash at hand, 15% short-term loan. It means that we have a loan facility that will attract an interest of 15%. And we have fuel expenses and commission received being an income. So let's move on to the additional information quickly. The first one we have is the depreciation. The moment you see depreciation, what should come to your mind is that you are going to prepare what we call a non-current asset schedule. So non-current asset schedule. The purpose for preparing the non-current asset schedule is to determine the net book values of the various assets you have within your business. So the current asset schedule will contain the cost of those assets you have, their respective additions you made within the year, disposals you made within the year. If it has not been captured within the trial balance, then it should be captured within the non-current asset schedule. And it is governed by IAS 16, that is International Accounting Standard 16. Definitely. So let's look at, first of all, let's look at the assets we have, the current assets the non-current assets we have within Sir John's business. And as I made mention of, we have the first item I saw was the fixtures and fittings. Fixtures and fittings, so you list them F and F. So fixtures and fittings is one. We have motor vehicle, NV. We also have plant and equipment, P&E. And the last one, we have building. Then the total will come here. It is very important for you to understand that although some of the assets or the non-current assets might not be depreciated, so you might choose not to bring it here. No. Try as much as possible to incorporate all the assets that has been given to you in the trial balance in your non-current asset schedule, whether you are going to depreciate it or not. So first of all, we determine the cost of these assets we have, and it can be taken from the trial balance. We have fixtures and fittings 7120, 7120. Then we have motor vehicle 5280. That's the cost. We have plant and machinery being 10,000. And building 150,000. So in all, take your calculator, 7,120 plus 5,280 will give us 12,400. Let me take my calculator. So you take your calculator, you want to sum up all the cost of the asset we have. So we have 7120. 7120. Let me use my phone. That one will be so 7120 plus 5280 plus 10,000 plus 150,000. So in all, we have 172,400. 172,400. So we've gotten to know that the total cost of this asset we have, or the total amount that we acquire this asset, is 172,400. Then you ask yourself, did we acquire some of this asset within the year that has not been captured within the trial balance? You might never know. But with respect to the discussion we are having, I want to bring it, whether it is in it or not. But in exams or any professional setting you find yourself, if you don't see any additional pages in the additional information, you don't bring it. So if there's any additional page, we call it additions. Okay, capture that one. So let's see if within the additional information they bought any asset or they acquired any asset and it has not been captured by us. So depreciation policy of the business is as follows. Building, fixtures, and fittings are depreciated on written down value basis at a rate of 10% and 15% respectively. Motor vehicle, plant and equipment are depreciated on straight line basis at a rate of 10% and 5% respectively. That means that we didn't acquire. Let's move on to B. C. Provision for doubtful debts. Purchases include 5,000 of goods bought for Sir John's personal use. We have inventory at 31st December 2023 was valued at 20% of fuel expenses prepaid. Insurance and advertising bill of 500 and 440 respectively have not been paid. Gideon, the sales boy for Sir John, was paid a salary advance of 400 at the statement of financial position date. Make the necessary adjustment for the loan interest. That means that we didn't acquire any asset or an current asset within the year, therefore it will be dash. Then the next question that should come to your mind is that did we dispose of or did we sell any of these assets within the year? With respect to the additional information, we didn't sell. So disposal will still be blank. So we can establish that the total cost for the respective asset we have, F&F will still be 7,120, motor vehicle will still be 5,280, and plant and equipment will be 10,000. Building 150,000. So we will still have 172,400. This is the total cost. After we've been able to establish the total cost, the next question is that these assets, definitely they are going to depreciate. And when an asset is depreciating, it simply means that the value of that asset is going down or is falling. It can be due to wear and tear, obsolescence, a friction of time, advancement in technology. All these things can account for the asset or the non-current asset we have going down. So let's see the policy of the business. So depreciation will have its form here in order for you to understand. That is why I'm breaking it down as such. So the depreciation, we have the current year's depreciation and the depreciation that we've set aside the previous years since the inception of the business. So the depreciation that we are going to compute for this year, we will do it. But let's start with those that we've set aside for the previous year. We call it accumulated depreciation. So accumulated. Go through your trial balance. It's always given in the trial balance, and you get, So for fixtures and fittings, the accumulated depreciation is 560. This is just pick and drop. So if we could attest to the fact that preparing your non-current asset schedule is not difficult at all, because all these things that we've done, I just picked them from the questions, and you are going to get your text. Don't tell me that, oh, I don't know how to even start. All the things that you've seen here was picked from the question without computing for anything. So that is why I keep on saying that accounting is not difficult. We have calculated depreciation for F&F being 560. Then we have motor vehicle being 480. We have plant and equipment being 2,000. We have building representing 50,000. So the total accumulated depreciation will be 52,000 to be 53,040. But let me try and see if I'm correct. So I have 560, 480, 2,000, and 50,000. As I said, 53,040. So I'm correct. Since we've been able to establish the accumulated depreciation, and I define it to be the previous year's depreciation you've set aside, let's come to the current year depreciation. The year that you are preparing the income statement, what will be the depreciation that you are going to charge against your income? So say current or current depreciation. The reason why you see that I just wrote here accumulated without the depreciation is that I already have depreciation here. Here is current. It means that it's current depreciation. So the current depreciation is based on the policy of the organization, the method of the depreciation as well. So according to this question, the policy of the organization is that they should depreciate building fixtures and fittings are depreciated on written down value basis at the rate of 10%, 15%. That means that building is depreciated 10% reducing balance method, and F&F 15% on reducing balance method. When we say reducing balance method in accounting, it's a form or a method of depreciation that take into account the current value of the asset before you depreciate. It means that before we can depreciate F&F, we must take the previous year's depreciation from the cost before we can apply the rates. From the name, written down value. So the value of the asset has been written down. It means we are going to take the previous year's depreciation we've charged from the cost before we apply the rate. So building is 10%. Let's work for the depreciation. The cost of building, as at 720, accumulated depreciation 560 to be 6560. Then we apply the rate of 10% on it. So we will get, if you take 560 from 712, you get 6560. So 6560 times 10 divided by 100. You will get 656. 656. Then the next one is building. We said building 2 is reducing or written down value. So we will take the previous year's depreciation from the cost before we apply Each rate is 15%. So 50,000 from 150,000, you will get 100,000. 15% of 100,000, you will get 15,000. So 0.15 times 100,000. As I said, it's 15,000. Then we come to the motor vehicle and plant and equipment. So motor vehicle, plant and equipment are depreciated straight line. One of the easiest way for depreciating an asset is using the straight line method or basis of depreciation. So it's just straight. You apply the rate of depreciation on the cost of the asset. So motor vehicle is how much? Motor vehicle is 10%. So 10% on this cost will give us 528. Then plants and equipment, they are saying is 5% straight line. So 5% on the cost will be what? 5% on 10,000 will be 500. So we are done. These are the current depreciation that we've computed with respect to the various methods. So we add them to get the total current depreciation. So let's take our calculators and sum up the individual current depreciation. First one, 656 plus 528 plus 500 plus 15,000, which will give us 16,684. 16,684. We have gotten the accumulated, we have gotten the current. The main essence for preparing the non-current asset schedule is to determine your net book values. And when you say net book value, it's the same as total cost deduct minus, or you deduct total depreciation. And the total depreciation takes into account accumulated depreciation and the current year's depreciation. So let's find the total depreciation first before we come to the NBV. NBV is the same as net book value. So let's take our calculators. This one will be 6, 1, 12. This one will be 8, 0, 10. This one will be 2,500. You are adding, this one will be 65,000. So let's take the total depreciation by confirming it from our calculators we have. So 560 plus 656 is 1216. We are correct. 480 plus 528, 1008. We are correct for that one. 2000 plus 500, 2500. We are correct. And 50,000 plus 15,000, 65,000. So let's sum them up. 1216 plus 1008 plus 2,500 plus 65,000, making 69,724. So this is the total depreciation consisting of the accumulated depreciation and the current year's depreciation. So what shall we do? Don't underline this, but I want to underline it one for you to know that this is different. So we are going to deduct this total depreciation from the total cost. That will give us our various net values. Then we are done for the non-current assets level. So let's take our calculators again. 7,120 minus 1216. We get 5904. 480. No. 5280 minus 1008. Get 4272. Then 10,000 minus 2,500 will give us 7,500. Then 150,000 minus 65,000, we get 85,000. So when you are done, we want to know the total value or the total net book value of the asset. Sum up the respective net book values for the assets. So 85,000 plus 7,500 plus 4272 plus 5904. We will get 102,676. This means that these are the respective current values of the asset we have. F and F is now 5904, but it was 7,120. Motor vehicle, because of depreciation, it has reduced, or it has fallen to 4272. 10,000 of PME is to 7,500. The same price to build. So this is so simple. In case you have additions or disposals, the same way we have it here, if you are buying an asset and it wasn't captured in the additional information, but you are coming to capture it here, it means it will have an influence or effect on your current year depreciation if the asset was acquired within the year that you are preparing the statement. I know by this time, with this simple computation to be done, you are not going to have an issue. But if you have an issue, kindly let me know. I'm bringing the video to an end. Let me see if there's anything that you need additional explanation. I said the main purpose for preparing this is to actually arrive at our net book value. But before we can get our net book values, we have to establish the various costs of the assets that we apply the asset for. We also ask ourselves, did we apply some of the assets within the year that the accountant couldn't capture in our books? If it is so, it must be given. But in this question, we don't have any disposal, we didn't sell any asset, we didn't buy any asset. That's why we have the blank space there. It comes to our completed depreciation. This one, it was being given. In some questions, you might not see a completed depreciation, but you see provision for depreciation. They are the same thing. Then we computed for the current year's depreciation. We got our total depreciation and we deducted the total depreciation from the total cost, and we got the various net book values. Last thing is that the current year's depreciation that we charge will go to your income statement as operating expenses. So if you go to your income statement under the operating expenses, depreciation is an expense. So we charge 656 in the name of FNF, NV, P, their respective current year's depreciation must be stated in your income statement. And when you go to the statement of financial position, this will be the value of FNF. Motor vehicle, this will be the value. Plant and equipment, this will be the value. And building, this will be the value. Thank you very much. I wish you all the best.